Top three things this week I'm going to talk about are the global recovery or lack thereof, what's happening in the global economy. Secondly, earnings, just give you a little update on what's happening with the earnings season now. Earnings coming out in the U.S., companies are beginning to report. And finally, a little chat on interest rates. Before I jump into those three things, though, just a reminder, for those of you who have given me a review on Advisor Ratings, thank you very, very much. I really do appreciate that. If you haven't had an opportunity yet to do that, please, I would really appreciate it if you could jump in there and give me a review. Secondly, you would have seen an email about the UN 17 Sustainable Development Goals, and I want to get your feedback on the goals that you want to support and that you support, and that will help me determine the projects and things that I support in my business. So please, if you haven't had a chance to jump on that and give me some feedback on the goals that resonate with you, that would be fantastic. And then just finally, a quick update on Interactive Brokers. I am getting through setting up all the accounts, moving money into that. It's been a little bit more of a process than I would have hoped, but anytime you change to a new platform, there's always going to be some teething pain. So I thank you for your patience. I am trying to get as much reporting and other stuff out to you guys, making sure that you're getting your account opening letters and so forth. I think there's just a few teething pains. Unfortunately, because the office that I deal with is in Hong Kong and there's all that turmoil going on there, I would guess that is probably impacting some of their service levels. But in any case, just bear with me. I'm really happy with the platform. It's going well so far, and we're getting there. We're getting there. So thank you for all of that. Now, let's talk about item number one, global economic recovery. On your screen, you see a headline which came out from CNBC probably a good hour or two ago. I haven't refreshed the page. It says 32 minutes, but it was a couple of hours ago. China's economy is continuing to slow. It only grew at 6%. Now, China's used to anywhere between 9 and sort of 10 or 11% growth on average, and they've just been slowing over the last few years. That is because they're becoming a mature economy, but it's also because they have some systemic issues in their economy, in their banking system, and in their shadow banking system. But the point is that the mainstream media is going to blame the trade dispute, but this has been going on for well over a year, and it isn't just about the trade dispute. And if there is an immediate resolution to the trade dispute, China's GDP isn't going to shoot up. Furthermore, there's all these tweets and all this stuff coming out around the trade dispute, and Trump has had this great, awesome deal that he's made with the Chinese, or they've agreed to stop tariff increases and stuff like that. But the reality is there's some really serious geopolitical stuff going on here. And before I show you some charts, I want you to think about this. I just watched an interview with a retired brigadier general who was a specialist in the China economy and China in general, and was a consultant to or consulted to the Joint Chiefs of Staff in the U.S. So this is a pretty heavy hitter in terms of his knowledge and expertise around China. And I watched the interview, and just a couple of the key things that I probably heard and knew but didn't really think about a lot. And that is, number one, China, we all know it's a communist country, but they really do have a pretty tight grip and an iron fist over what goes on over there, both in the economy and with their population. So number one, they have capital controls. Money just kind of doesn't get out of China. The elite and the really super uber wealthy there have ways to get capital out of the economy there, out of the country. But for the most part, the average Joe there in China can't get their money out of China and invest it around the world. Number two, China is a horrendous human rights violator. Now, I don't know a lot about this, but I do know that the record for China and their human rights record is horrendous. And this is something that I think the world, for whatever reason, has maybe overlooked a little bit in the last probably 15 to 20 years because China's economic power has been growing. But China is a very, very, what's the word I'm looking for? I'm lost for words. That's unusual. It's a very challenging place to do a lot of things. Business, to relate to the population and to relate to the leaders. And I think they are very much a cultured and well established global player, right? This society and the Chinese nation has been around for thousands of years, right? So they're playing a very, very long game as well. But my point is that this trade war is a bit of a high level dispute where there's a lot of other stuff going on. So China is a well-known um, thief of IP from U.S. companies and all this kind of stuff. It's just amazing. This interview talked a lot about that. But what I wanted to, where I'm going to connect this to, is the fact that even if we get a trade dispute resolution, the stock markets of the Asian communities and really of the world are signaling that it doesn't matter, right? It doesn't matter that we're going to get a trade resolution. People who are in the know that it's not going to make any difference to the global economy. And I'm going to demonstrate that to you right now if my screen comes up. Hopefully what I'm going to get here is a chart of the Shanghai Composite. Yes, there it goes. And what I want you to focus on is the fact that towards the end of this chart, so over here, if we were going to get a resolution to this trade dispute, this chart would be going up. There would be confidence in that stock market and people would be buying equities in China. They're not doing that. On the contrary, it's selling off. It continues to sell off. And you can see that from the sort of right to left downward sloping. Of course, there's some cycles in there. People get hopeful about a trade deal, whatever, and then it sells off. But I'm telling you now, if we were really going to get some great resolution out of China and between them and the U.S., the stock market would be smashing it. Very similar picture with Hong Kong, the Hang Seng. If it comes up, same deal. Look at that. I mean, we're getting a little bit of a lift, but nothing. It's like it's kind of a big deal. Lower high. It's probably rolling over at this point, and it's just been horrendous, the performance. Finally, Koreans don't believe it either. The Kospi is another stock market, if it opens up, where just horrendous. From early 2018 where it peaked to now it's down, I don't know, 20% or something like that. It's just a horrible performance. And again, if the world really thought we were getting this really, really great trade deal, it would be buying those markets because they're big export markets. They drive a lot of the global economy and people would be investing in the equities there. They're not doing it. So don't let the mainstream media headlines fool you into thinking that we are out of the woods and that we're on the cusp of some great result from this trade deal. I guess the final one I should see if I can quickly find for you is the ASX, if I can quickly find it, because the ASX would be a similar chart. Let's just have a quick look at that, where even the performance of our stock market over a year has been pretty muted. So, it's very similar looking chart where we had this run up from late 2018, early 2019, Federal Reserve started cutting rates. The Reserve Bank in Australia started cutting rates. We got a bit of a boost in the market, but we haven't gone back to our all-time high, and we've kind of rolled over. So again, if the Australian market believed that we were going to get a trade deal and that China was going to start growing again epically or whatever, you'd see the Australian stock market really pop. We're not getting any of that. Finally, and I won't show you any charts, but the price of oil, the price of copper, the price of iron ore, all of these things are doing nothing. In fact, they're rolling over. So once again, we're just not seeing that. So let's turn to earnings. And I just want to show you, we're in an earnings reporting season right now. And I've shown you these tables before. And basically what they show is this is the S&P 500 in the U.S., some of the 500 largest companies in the world. So far, about 50 of them have reported. And what we're seeing from these companies on balance thus far is negative earnings growth. And that's a bad deal. And particularly we're seeing this in the software and infotech space and also in the financials. And then we're going to see it in energy as well. Even though it's looked pretty good here, I think we're going to see energy probably be negative. But what this is telling us is, first of all, the market is priced for I guess, a good earnings season. But particularly in the tech space where the tech names and a lot of the tech space is very richly priced. And this is reminiscent of any stock market crash we've had in recent times where all of a sudden the market wakes up and goes, oh my God, earnings are negative and sales growth is down and what have you. And all of a sudden they reprice equities. And I've been talking about this for a while, and this is the evidence that supports that what we're seeing on the highest levels of the Dow and the S&P 500 in the market, the underlying currents of the market are not suggesting that. And you can see that in indexes like the Russell 2000, Russell 3000, which I won't show you, but those are even a broader base of stocks. But the point about earnings is this is going to be one of the worst comparable periods, worst 4 comparable periods in the last year. So what that means is the comps for the same time, the same quarter last year are better than they are for this quarter. And when people see those comps, they're going to be like, oh my God, earnings are declining and the stock market's too richly valued. And we're just going to have to see what happens around that. Now, what this could lead to, and this is the third point I wanted to talk about today, was interest rates. What this should lead to, and will most likely lead to, is further stimulus from the central banks. Now, the U.S. Fed has already started QE again. They're not calling it QE. They're trying to be very clever and call it something else, a repo or whatever, repo facility, but it is quantitative easing. Anytime a central bank buys assets and puts them on their balance sheet, they're monetizing these assets, and that is quantitative easing. They're putting liquidity into the market. So they've started again, and it's only a matter of time before they full on, accept it and continue to do it. What that means is, or what could happen, I should say, in the next month to 2 months is earnings season, which is currently in play. Once we get more reporting, we'll see what happens. The stock market may look at that and go, oh my gosh, and it will reprice. We might see a 10, 15, 20% drop, who knows. The Federal Reserve will then have the cover to cut interest rates. Now, they might go 25, but they could go 50 basis points. And what we'll then see is all the bonds and the bond proxies like real estate, utilities, not corporate bonds, but government bonds, all interest rates falling on all that stuff, and thus things that are interest rate sensitive, like government bonds, like utilities, like gold and gold proxies, gold miners, they will all get a lift. And the U.S. dollar should start to come off its highs and its peak and start to fall against other currencies. So I've been talking about this for a little while. We're in this interesting spot right now where there is effectively a black hole of risk that is swirling around that could envelop us and cause some problems. So these are the things that I want to highlight for you because we are still in quad 4, which means negative growth. This is negative GDP, or not negative, but falling growth and substandard growth. Interest rates that are falling, and inflation that they just can't seem to get started. Now, one of the interesting things about inflation is we're starting to see some signs out there that there's a bit of inflation. And so if the Fed has to cut interest rates in order to get the US dollar to come down. Now, once the US dollar comes down, that's going to start triggering off inflation. Things like oil, commodities, gold, etc. They're all going to start to rise off the back of that. So what we could very well be entering into here very soon is a period of higher volatility, lower stock prices, lower interest rates, and a bit of a flight to safety. So people moving out of stocks and equities into bonds and gold and that sort of thing. So to bring that back around to quad 4, that's why we're staying positioned in quad 4 assets, because the data has not suggested or shown that it's time to move out of that quad. Now, I think I said in my last update last week that the next quad we'll go to in the US is very likely a quad 2 scenario. Now, we'll only barely get into that quad because the data, whilst it does support a potential move into quad 2 at this stage, it's not like a full-on, we're definitely in quad 2, we need to just crank all the asset allocations and sectors for quad 2. It's more like a tepid, we're kind of in quad 2, probably won't stay there, probably drop back into quad 3 or potentially quad 4. So what I'm trying to do now with asset allocations is A, not jump the gun and reposition into quad 2 and wait for the data to confirm. But secondly, we will be putting on stuff or retaining stuff that does well in a quad 3 or quad 2 environment. So it's going to be a little bit of a balancing act over probably the next 3 to 6 months. But I'm all over that and just waiting for data confirmation on some of that stuff. Now, what I wanted to lastly, I just wanted to show you was this chart and table that I often, if I can get my screen to work. There we go. I show you very often a volatility matrix. So if you can see that now on your screen, there's a volatility matrix here. And probably the last time I showed this was potentially sometime around that month ago period. And I'm just going to draw your attention to my cursor here, where a month ago, the market was very complacent. And that's what a negative volatility vol number means, is that the market's very complacent. It's usually rising and people aren't worried about volatility is probably falling, and people are very complacent around what's going on in the market. And that's the best time to put on shorts. It's the best time to sell premiums, so you sell calls and things like that if you're an options trader. It's also a time to take profits in certain things. And what I wanted to juxtapose that with was a week ago, right? So look at this column here. 1W is 1 week ago, where there were quite a bit of vol premiums. And what was happening a week ago, and I'm quickly going to bounce over to Interactive Brokers and show you a chart. This is a chart of the S&P 500. I just want you to focus on a month ago. This is what was going on. So a month ago, we were in this uptrending market with the S&P. It was looking pretty strong. It was hitting new highs, and that's why people were complacent, because the S&P 500 was, and the markets in general were doing quite well. But look what happened here. Even as much as a week ago, we had a big smackdown, like right here, bang. This is sort of early October. We had this volatility and this big sell-off in the market over a couple of days. And that, I'm just going to flip back to the PowerPoint. That's what triggered a shift from a negative or a discount to a premium. And this would have been the time here to put on long positions and put on some positions that got hit because of the increase of volatility and so forth. But if that doesn't make any sense, you don't worry about it. But what I want to just highlight for you right now is we're in a period where obviously some of these numbers are showing discount, some are showing premium, but only small premium. And we're entering into this kind of interesting phase right now where I suspect when I look at this in another week, we'll probably see much more red here, which will signal that we've reached more complacency. And this would be a time to potentially take some profit off the table on certain trades and so forth. I don't really do that kind of thing, but I'm just educating you as to the cycle that we go through. So what you can clearly see on this type of data is that there is a cycle. We go from, and it's the pendulum of fear and greed, right? We go from a period of probably complacency and greed, which is this discount, to a period of fear and panic, which is what you get when you see these big premiums. So it's just interesting that even on short-term basis, 1 month to 1 week ago, you see that cycle in play. So right now, and the last thing I'm going to close off on is just a little bit of a chat about interest rates and some of the quad 4 positions. Quad 4 in the last week to 2 weeks hasn't performed really well. And that's what happens. And that's this cycle playing out, is that over the long term, I'm trying to get the macro positioning correct. And I recognize that within the long-term positioning, and even long-term is 6 to 8 months, can be 6 to 8 months. It's not years and years and years. Within that positioning, you're going to get mini cycles or things where the market corrects one way or the other. And so as long as you understand as my client, and this is why I love the quad system, that we're in a particular quad, you don't necessarily have to worry about, is this week a down week for my portfolio or an up week? Because you're always going to have weeks like that. It's over the longer term, the 6 to 12 month period. Are we seeing sustainable and sustained gains in our portfolio, and are we positioned correctly? So these are some of the tools that I use, and I'll continue to talk about them and educate you on that stuff. If you do have any questions about any of it, please do let me know. I'm always trying to learn more myself about all of this stuff. But if it's something that you're not too worried about, then don't worry about it. Sit back on a Friday afternoon, have a nice mojito, enjoy this lovely weather that we're having, and I will, that's one last thing. I am traveling next week to the U.S. I'm going over to play baseball and visit my mom in Phoenix. And so I will be probably on the air, but delayed response on some things. But in my absence, of course, Lady, who's doing an absolutely awesome job with everything, I hope you agree on that. I certainly think she is. Will be able to look after you, and I will most definitely continue to keep my eye on the markets. And because I'll be over there in the U.S., I'll be while you're sleeping, I'll be either playing baseball or probably watching my computer screen and looking at markets. So if you do have any questions, though, please give me a call or shoot me an email, and I will look forward to chatting with you next week from Arizona. Have a fantastic